Understanding personal guarantee, a comprehensive overview. What is a personal guarantee? A personal guarantee is a legal commitment made by an individual, often an executive or partner of a business, to personally repay credit issued to the company. This becomes crucial when a business, particularly a new or small startup, seeks credit but may lack the necessary credit history or financial foundation to qualify independently. A personal guarantee serves as a safety net for lenders, ensuring that if the business defaults on its debt, the individual stepping forward as guarantor will be held accountable for the repayment through their personal assets. Key takeaways. A personal guarantee is a direct legal commitment to repay business debts. They are predominantly used by new or smaller businesses with insufficient credit histories. Such guarantees protect lenders by allowing them to pursue the guarantor's personal assets in case of default. Business owners must diligently review credit applications to identify any clauses that impose personal liability. How personal guarantees function. When business owners apply for credit, such as loans or lines of credit, lenders often require a personal guarantee, especially for businesses that are either newly formed or exhibiting a weaker credit profile. Here's a deeper dive into the mechanics involved. 1. Credit application process. Personal guarantees typically come into play during the credit application process. Lenders require personal information from business principals, including social security numbers, SSNs, personal credit scores, and other financial details, in addition to the company's documentation such as the Employer Identification Number, EIN. This inclusion helps lenders assess the creditworthiness of both the business and the individual. 2. Asset pledging. Individuals making a personal guarantee may also need to pledge their personal assets, like bank accounts, cars, and real estate, making them liable to repay the business loans from their personal finances if the business fails to honor the debt. 3. Enhanced credit accessibility. By tying personal assets to business financing, personal guarantees can significantly enhance a business's ability to secure necessary funding, thus fostering growth opportunities. 4. Risk to creditors. The legal framework surrounding personal guarantees enables creditors to pursue the individual's personal assets if a business defaults, significantly reducing the risk they are exposed to while lending. The implications of personal guarantees. Business ownership often requires significant initial investment, and relying on personal guarantees can create a protective hedge against financial loss for creditors. However, if the business struggles to generate sufficient revenue, the risk of personal financial loss for the guarantor increases substantially. Historical context. An interesting example highlighted in a 2018 New York Times report involves former President Donald Trump, who had personally guaranteed roughly $421 million in loans and debts. This strategy highlights the duality of personal guarantees. While they can secure funding, they can simultaneously expose the guarantor to substantial financial risk. Special considerations when pursuing personal guarantees. While established businesses with solid credit profiles may sometimes avoid personal guarantees, they can still benefit from them by securing lower-cost credit options. Nonetheless, the potential risks remain substantial. Should a business default, the individual who provided the guarantee faces possible bankruptcy or significant loss of personal assets. Credit terms to watch for. When exploring credit options, it is vital for applicants to scrutinize the language detailing personal guarantees. Look out for statements within credit applications that convey mutual liability, such as, "You, as an individual and the authorizing officer of the company, are agreeing to be jointly and severally liable with the company for all charges to the account." The role of SBA loans. Many private lenders require personal guarantees, and it's crucial to note that the Small Business Administration, SBA, also mandates this when approving loans. Any principal with a 20% or greater stake in the business must provide an unconditional personal guarantee, solidifying the lender's recourse in the event of loan default. Types of personal guarantees. Personal guarantees can generally be categorized into two main types. 1. Limited guarantees. These are capped either at a specific sum or a percentage of the outstanding debt. They are common in situations where multiple partners have stakes in the business, allowing lenders to pursue only a portion of the debt from individual guarantors. 2. Unlimited guarantees. As the name implies, this type exposes the guarantor to total liability for the entire loan amount. SBA loans typically involve unlimited guarantees, meaning if the business is unable to meet its loan obligations, the lender can pursue the guarantor for the full debt, including assets beyond liquid forms like bank savings. Conclusion. In conclusion, personal guarantees represent a dual-edged sword in the landscape of business financing. They can be a vital tool for securing credit, especially for new ventures, but they also entail significant risks for the guarantors involved. By understanding how personal guarantees work, the types available, and their implications for credit applications, business owners can make informed decisions that align with their financial strategies and risk tolerance. Prospective borrowers should always seek to read and comprehend the fine print associated with personal guarantees in credit agreements.